this session we're going to look at how we record entries in the ledgers. Now first of all, there are different types of ledgers. There's the general ledger, also known as the main or nominal ledger, and in this book we record all of the business's transactions and show the effect of those transactions on the business's assets, liabilities, capital, income and expenses. In addition to the general ledger, we will also have two subsidiary ledgers. The sales ledger, first of all, in which we record anything that affects the amounts owed by individual customers. So we'll record each customer's sales invoices, credit notes, sales receipts from customers and so on, so that we can calculate how much each individual customer owes the business. In addition to this ledger, we'll also have the purchase ledger, and in here we will record anything that affects the amount of money that's owed to individual suppliers. So again, similarly, like the sales ledger, we will record things like the purchase invoices, credit notes, payments to suppliers, anything that will affect how much we owe to individual suppliers. So what do our three ledgers contain? Well, these ledgers will consist of different accounts, and each account will usually have one or, for more substantial accounts, one or more pages devoted to that account in the ledger. The general ledger, each account will be named after the different types of assets, liabilities, capital, income and expenses that the business incurs in its day-to-day transactions. With respect to the sales ledger, the accounts in the sales ledger will be named after the business's credit customers, so we can so anyone who buys from the business on credit. And the purchase ledger accounts, well, they're named after the business's suppliers, anyone who provides credit to the business and will be paid at a later point after the invoice has been issued. The way that each of these accounts is laid out on the pages of the ledgers is known as a T account. Now, there are different formats to these T accounts that exist and that can be seen quite commonly in businesses, but the AAT does prefer to use T accounts. So here's an example of a T account. So it's simply a table where at the top of the page we'll have the account name that this T account is dealing with. We have a couple of columns on the left hand side of the page where we can write a description, and then under what's called the debit account we can write the amounts, and then on the right hand side we have another column again where we can write a description of the transaction, and a column headed credit where we can write amounts as well. Now the word debit is often abbreviated to the letters DR, and the word credit is often abbreviated to the letters CR. So what are these debits and credits? Well, we have a quick summary at this stage, but as you go through the course you'll see how debits and credits work in more detail. Debits represent increases in assets or expenses, and they can also represent decreases in liabilities, capital or income. Credits are the opposite of debits, so they represent increases in liabilities, capital or income, or decreases in assets or expenses. Another way to think about debits and credits is that debits record where funds of the business go, what happens to them, whereas credits represent where the funds actually come from. The final thing that I'll say about debits and credits at this stage is that the total of a business's debits must equal the total of the business's credits. Because after all, if funds have gone somewhere, they must have come from somewhere. So debits must equal credits. Let's now have a look at an example of a partially complete T account. So here we have the sales ledger control account, which is a type of asset, and it's an account that we would find in the general ledger. On the screen we can see that a number of entries have been made into the sales ledger control account. So we've recorded a balance brought down. This is simply the amount that was in that account at the start of a period. We've also recorded that the business has made some sales in this period and has also made some sales returns or issued some credit notes. Now, other than recording transactions in the T accounts, what you'll also need to do is to be able to close them down at the end of a period. Now, this involves a number of steps that we're going to go through now. First of all, we'll add up the figures in our debit column. That's the column on the left side of the T account, and in the credit column, the figures in the right-hand side of the T account. So in the example on screen, we have 60,000 in the 60,000 on the debit side and only 2,000 on the credit side. The next thing that we'll do is we will record a balancing figure in that T account so that the total of our debit and credit columns will equal each other, so they'll add up to the same amount, and we'll call this the balance carried down. So with our example, we've got 60,000 on the debit side, 2,000 on the credit side, so we need a balance carried down recorded on the credit side of the T account of 58,000. Now that we've put our balance carried down in the T account, we can now add up the total of the debit and credit columns, so they should now equal one another. And when we're recording these totals, we'll put borders around them. There's usually a single line above and a double line below the totals. So there we go, we've got 60,000 on both sides. The final thing that we'll do, now that we've finished with that earlier period, is we will bring the balance on that account down to the start of the next period. So what we do here is the balance carried down is brought to the start of the next period, so we'll record a balance brought down for the same amount as the balance carried down, but it's going to be recorded on the opposite side to the balance carried down. So we've got 58,000 balance carried down on the credit side of this T account. We'll record that on the debit side of the T account, just under the totals. What happens then is that the whole process starts again. So we will then again start recording sales, sales returns, and so forth.